Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are coming off of last week, which was an incredibly volatile week to start off the week, but we finished the week on the exact opposite end of the spectrum that we started the beginning of the week, which was an extreme amount of volatility at the beginning of the week and a fairly muted amount of volatility at the end of the week. Um, and if we look at the overall markets, I think there's a few things that we have to review as to what we saw last week. We started Monday morning last week with an incredible amount of panic in the markets. The VIX opening up at about 55% really spoke to kind of just how fearful market participants were going into Monday morning. We ended the week with the VIX at 20%, so a pretty significant retreat in terms of expected future volatility in the span of 1 week. We had the bond markets price in up to 125 basis points of cuts between now and the end of the year to start off Monday morning. And by the time we closed on Friday, that was basically a 50-50 coin flip between 75 and 100 basis points. So we basically had a pretty significant reduction in expectations for rate cuts. We also saw that the bond markets didn't particularly price in a lot of risk in terms of a recession overall throughout the week. And as a result of all of that, equity markets spent the better half of last week recovering kind of from Monday's selling. Now, I think for most investors that are watching today's session, the primary question is, can we resume the bullish trend that we have seen over the past 8-9 months? Or is this the start of something larger in terms of further downside? So what we're going to do is we're going to take a look at the charts and try to answer those questions during today's session. So if we look at the S&P 500, I think the most important level to pay attention to right now is 5,400, 5,450. That's basically the resistance level that we kind of have faced prior to the sell-off, and we're now coming up against those levels as kind of the next level of resistance here at the upside. After breaking down violently below the support level, we're now kind of coming back to retest that level as resistance. So you have both the 5,400 and 5,450, which is the 50-day moving average, acting as resistance here. Now, generally speaking, when you see huge spikes in volatility, huge downside moves like this and a subsequent rally, rarely do these rallies, historically speaking, just continue marching on as if the sell-off didn't happen, which is something to be aware of because volatility tends to cluster around each other. So there's a higher likelihood, in my opinion, of a pullback to at least retest 5,100 before kind of equity markets can stabilize and continue moving higher from here. That's something to just be aware of. Just historical patterns tends to favor a revisit of recent lows before it kind of stabilizes and moves on from it. So a bit of consolidation. We typically don't just sell off, panic sell, and then just go right back to as if everything was normal again. There's usually some level of angst from investors on the rally. Especially we're going into some of the thinnest markets throughout the year. A lot of people on vacation. There's not a lot of volume here in the markets. So for those reasons, there is a higher likelihood, in my opinion, of a short-term reversal from where we are, rather than just this is, everything is fine. We're going to continue moving forward. You see the same thing on the NASDAQ 100. We're coming up against that 452, 455 resistance level here on the NASDAQ 100. We're still quite a bit away from the 50-day moving average on the NASDAQ 100, which comes in around 472. But within this range, is an opportunity, I think, for the risk reward to be more favorable to the downside rather than chasing this significantly higher from here. And we also have seen the momentum here over the past few days really slow down here in terms of the rally. It's lost a lot of legs. Now, this week, we do have PPI coming out today, and we have CPI coming out tomorrow. So PPI just came out a few minutes ago. I haven't even had a chance to take a look at where that came in, but that's the inflation read that I think we're all looking for to better understand. How's inflation coming in, and from pre-market, looks like S&P and the Nasdaq is up a little bit. It sounds like uh, where PPI came in is certainly the markets are taking that as a positive here at the moment right now. So that's kind of where we stand on most of the major indices. You notice that the Russell 2000, as you can see, we got back to the 50-day moving average, but so far as being rejected here to the downside. That's sort of the template that we're playing with on the S&P and the Nasdaq 100 that we're working with right now. You have the equal weight S&P 500 rallying back to the 50-day moving average, but also so far finding that as a tough level to crack above. So we really need to see the Nasdaq and the S&P break above those 50-day moving averages in order to have a much better confirmation of bullish markets continuing. Before that happens, we're certainly much more in a neutral to slightly bearish outlook here in the markets in the short run, basically getting us at least through Labor Day, where kind of we expect participation to come back in. That's kind of our base case here right now for the next few weeks. We have seen value outperform growth by a substantial margin here over the past few weeks, but over the past few days, we have started to see growth start to outperform value here again. So that's something to pay attention to right now as far as when you're looking for a recovery, where is that recovery going to be coming from? Is it going to be value stocks playing catch up, or is it going to be growth names kind of leading the markets again? Early indications seem to show that growth names are kind of coming back to life a little bit. We'll see if that can continue here over the next few trading days. You have commodities staging a pretty significant rally back above a resistance level here. So, we broke down below the support level and now we've kind of cracked back above it. That's certainly a lot of that, I would say, is driven off of oil prices. Right now, I think the oil markets are effectively telling us there's a much higher likelihood of an escalation in terms of the tensions in the Middle East, and oil markets are reflecting that at the moment. And we're seeing both, safe haven buying from both gold and oil as a result of that. High yield bonds continue to remain fairly positive here. As you can see, it's trading just shy of those all-time highs on HYG or relative highs on HYG. And this is something that is showing us that the bond markets right now are not pricing in, a recession or concerns that, the credit conditions are deteriorating materially at the moment. And that's part of what the equity markets are reading into with regards to having more confidence in this overall rally that we've seen here in equities. The VIX, as you can see, we opened up the week, in that 55 range, got as high as around 65 or so. There are some questions as to whether or not that reading is actually accurate or not. But even if we didn't get so high here into the 50s, and that reading was kind of a false reading on the open, we did close at 20%. And that really speaks to kind of a pretty significant retreat of volatility here. But, the long-term average is around 19.5, 20. We're still trading above that long-term average. So we'll see if kind of we get another spike here in terms of volatility before it reverts back to the mean. That is the base case that we're operating under right now, that you do see some pickup in terms of volatility between now and, let's call it Labor Day, for example. The 10-year yield have tumbled a little bit here to that 3.87 level here. So we have seen a bit of a resurgence here in terms of expecting a 50 basis point rate cut here in September, even though Chairman Powell has largely, explicitly said that that's off the table. We'll pay attention to kind of how bond markets are pricing that in, because that's going to have a pretty significant influence on kind of our equity market outlook. TLT, a big round trip, broke out above 94 significantly last week, came back all the way to retest this level as support, and now is bouncing back higher here again. And that also points to lower rates here, which is going to be supportive of equities. That's also going to be negative for the US dollar. As you can see, breaking below 103.25 as support, coming to retest this level as resistance. Our base case is for dollar to show some further weakness as 10-year yields start to decline, and yield in general on the US dollar continues to decline relative to other currencies. You have gold yesterday getting to a new recent high at around 2,500. So this certainly is starting to set up for what looks like a further breakout here on gold. That would complete this kind of this formation that we've seen. Call it a consolidation formation, however you want to call it. You had this rally into the consolidation range, and now it's breaking out to the upside. That would project up to 2750 here to the upside based on this expected move, consolidation and continuation higher. So that's a pretty significant further upside opportunity here for gold, GLD, gold mining stocks. Had a great day here last week. Oil punching out above the 50-day moving average, above $80, above kind of all the critical resistance levels here around 76. Reaching to that $80 level. This really starts to target 84 here to the upside, and 88 to extended targets here to the upside. Those would be your two initial targets here for oil. So energy stocks likely will come back to life. OIH, USO, all of the ETFs tied to oil likely will see a spike here over the coming weeks as oil prices respond to the elevation of geopolitical tensions here in the Middle East. And then looking at the sectors, technology staging a little bit of a comeback here after what has been one of the worst performing sectors here over the past 3 weeks prior to last week, showing a little bit of relative performance here relative to the S&P 500. Not quite enough. As you can see, we're still pretty far away from the 50-day moving average here. But as you can see, the growth names are coming back to life a little bit, and we'll see if that can continue here over the next few trading days. Consumer discretionary actually losing some further ground here. You saw Home Depot's numbers this morning disappoint. That will likely add to further underperformance here for consumer discretionary, both on an absolute and a relative basis here as well. Communications, one of the few sectors that are seeing relative strength on the back of last week. So communications still quite strong, despite Disney's kind of disappointment at the end of last week. Financials also holding in nicely here, well above the 50-day, above the 50-day moving average here on XLF. So certainly one of the stronger sectors right now. Consumer staples also relative performance incredibly strong, back to kind of new recent all-time highs. Above that $78 level here, and we'll kind of continue to monitor that to see if we can get back above 78, 79 and continue the slow grind higher here on consumer staples. Healthcare also relatively strong here near the 52-week high, bouncing off that 50-day moving average, looking for continuation higher here in healthcare, outperforming the overall markets for the past month or so by a pretty significant margin on XLV. Whoops. Materials showing some weakness here over the past few weeks, but specifically over the last week or so, showing some weakness. And as you can see, relative performance is starting to decline a little bit after what has been one of the stronger sectors in terms of relative performance we've seen here, giving some of that relative performance back. Industrials, on the other hand, so far holding on to those relative gains, holding on to that 50-day moving average. This has been driven by some of the defense stocks that are in the industrial complex. So industrials holding up a little bit better than materials as a result of that. Real estate really shining here over the past few weeks as interest rates continue to decline. This is certainly one of the sectors that have been held back by higher interest rates. And as interest rates decline, we have seen a pretty significant outperformance here for real estate relative to the S&P 500. And as rates continue to drop, that's going to be supportive here for XLRE. Energy is still below the 50-day moving average, but based on kind of where energy prices are headed, this looks like this could potentially be a catalyst that breaks XLE above the 50-day moving average and continues moving higher from there. Utilities also benefiting from kind of lower rates here right now. breaking out above the $72 double top. Breaking out above the $72 double top and continuing moving higher from here would be our base case right now for utilities. Home builders, note that the decline in rates have not benefited home builders here over the last week or so. We saw the softness from Home Depot this morning in terms of their earnings. And think about Home Depot predominantly catering to professionals does not particularly bode well for the home builders industry at the moment. So showing some of that relative performance concerning that relative performance will continue going forward, which could break below that 50-day moving average here for home builders. And semiconductors also failing to really stage much of a rally here right now. As you can see, we have 215, which is a gap that's about to be filled here. And we'll see if this kind of declines from where we are here, or if semiconductors can break back above 215 and get back into that 235 level. Regardless, you have a fair amount of resistance at 235 to 240 here, which is the 50-day moving average and the resistance level that I'm referring to. Even if you break above 215, you're facing some heavy resistance in those areas. So I think the semiconductor industry is going to be a tough one for traders here over the next few weeks. You're likely going to see some interest initially, but that interest could very well wane fairly quickly. So pay attention to here for semiconductors, because obviously a lot of investors have positions in semiconductors, and many of you may be underwater in those positions and you're trying to get back to break even. And a lot of investors are going to be in that same camp. And as soon as they get back to break even, they're likely going to be sellers. So definitely a concern for semiconductors as it is a pretty crowded trade. And when selling kind of ensues in a crowded trade, they tend to fall quite quickly. So that's kind of how we're viewing the overall sectors and where we are positioned for. So looking at some ideas for today. The first one that we found here is Comcast. We've mentioned Comcast here in previous sessions. Comcast at the moment trades at a pretty significant discount relative to its sector here. 38.5 is a major support level after what has been a bottoming formation here. We're looking for that risk reward to be fairly favorable for stocks like Comcast to kind of bounce off of these support levels. It trades at only about 10.5 times forward earnings versus the industry average of about 12 times forward earnings. So we're talking about a little over 10% discount to its industry, yet it's expected to grow basically in line with industry for both top and bottom line. It's got margins that are slightly better than its industry. So it's certainly, there's no reason that it shouldn't trade at the very least back in line with the industry. So that in itself from a valuation perspective correlates to about a 15% upside from where we are. And from a technical perspective, you have a bottoming formation that's looking like it's starting to kind of see a series of higher highs and higher lows that basically can be the catalyst for this to continue moving higher here for Comcast. The next idea that I want to talk to you guys or show you guys here is Shopify. Shopify, a big move here on earnings last week. A gap fill level at 75 that remains unfilled. That would be your immediate upside target here for Shopify. And then you also have 82.5, 83, and slightly above 90, 92, 93 here to the upside as kind of extended targets here to the upside for Shopify. Shopify trades, it is a newly profitable company. So generally speaking, for those types of stocks, you wouldn't use PE ratios because they're not either not profitable or just profitable. So those ratios typically don't mean a whole lot. We typically use something like a price to revenue. In this particular case, I'm using enterprise value to forward revenue to value this stock. It's trading at just slightly higher than its industry average at about 9.5, almost 10 times enterprise value to forward revenue versus the industry, which is about 7.5. So you're talking about a 33% premium relative to its industry. But if you look at the growth rate expectations, we're talking about head and shoulders above its industry. Its industry is expected to grow fairly quickly at about 21% year over year in terms of EPS growth, but Shopify is looking at, well into 100% EPS growth year over year. So you're talking about five times the growth, more than five times the growth of its industry, of its peers. Revenue growth of about 21%, which is more than double the expected revenue growth for the industry. Net margins are in line with its industry at around 16, 17%. The industry average is 18. So given the fact that it's just newly profitable and it has margins that are in line with the industry and it has growth rates that are head and shoulders above its industry, the fact that it only trades at a 33% premium relative to its industry, I think is a relatively bargain for Shopify. And you see the technical levels. The reason we had this big bounce here on earnings is because investors are starting to catch on that these valuations are low given the expected growth rates for Shopify, which is why my expectation for Shopify is to continue this bullish trend and continue on given the valuations and the technical setup that we see for Shopify. Some bearish opportunities to take a look at here. Chipotle. We actually just got news this morning that Chipotle CEO is departing for Starbucks. So we've seen about a 30% decline in Chipotle here over the past few months. We've now had about a 15% rally here to the upside. That certainly makes the risk to reward ratio a little bit more favorable here to the downside as momentum remains negative and we remain below key support levels here on Chipotle around that 55 level. So you have this kind of topping formation where you have a lot of investors that are trapped here to the upside as they kind of get back towards break-even levels. You have selling pressure that could bring the risk to reward ratio more favorable here to the downside. And if you look at Chipotle, the valuations here is really what is compelling. It trades at 50 times forward earnings. The industry average for the restaurant industry is 26 times forward earnings. So we're talking about an valuation that's nearly double the industry. Yet when you look at the expected growth rates, they are higher than the industry, which is expected given the high multiples that it's trading at. But if you look at the growth expectations, the industry is expected to grow about 11%. Chipotle is 18%. Revenue growth, the industry is about 7%. The Chipotle is about 14%. So it is expected to grow significantly faster than the industry. But is that worth double the valuation? And you have to also look at margins. Part of the reason that we saw the 30% decline in Chipotle over the past few months is because investors are concerned about margins. Their margins are below the industry. For a company that is growing incredibly fast, their margins are just not there, and they're sacrificing margin in exchange for growing fast and executing on kind of what seemingly looks like a lot of store openings, a lot of revenue growth, a lot of EPS growth, but it's at the expense of profitability. So when you think about all of those things on balance with each other, trading at double the valuation of its industry, I think it's a little risky, and the stock is kind of priced to perfection to some degree. Any concerns around slowdown, any concerns around margin pressure is likely going to continue to add some downward pressure here for Chipotle, which is why Chipotle meets one of our bearish criteria here for trade ideas. And I'll leave you with one last one here. ETN. This is a utilities company that has been a lot of interest because of the fact that they provide electricity and electricity products to data centers. And we know with the recent kind of hype around AI, AI is extremely power intensive. So data centers, have a lot of data needs. But as you can see, if you look at kind of the price, the chart here of ETN, you have this classic head and shoulders pattern where the neckline has been broken. And this would kind of target here, potentially 250 here to the downside. So the fact that we broke below that level, almost reached 250 and bounced all the way back up towards that neckline means that the risk to reward ratio is still favorable here to the downside towards that 250. And in this particular case, the fundamentals also back this story up because even though it trades at a multiple that's about it trades at 30 times forward earnings versus the industry average, which is about 25. So you're talking about 20% higher valuation than the rest of the industry. Yet, growth rates are basically the same as the industry. EPS growth expected is about 13, 14%. That's the industry average. Revenue growth rate about 7, 8%, which is slightly higher than the 6% industry average. And then net margins basically exactly in line with the industry. So this is a company that's not growing any faster and not any more profitable than the rest of its peers, yet it trades at a valuation that's 20% higher than its peers. That's really kind of where you take 20% off the stock price, you're going to end up somewhere close around 250. And that's why from a technical and fundamental perspective, this aligns for some further downside, especially as you see that head and shoulders pattern start to form, and then it targets 250 here to the downside. This is really where I think the fundamentals and the technicals align fairly well. So those are 4 ideas to share with you here today, 2 bullish, 2 bearish ideas to kind of start you off the week. And hopefully this gives you a better understanding of kind of how we're viewing the macro picture. Overall, things will look a lot better than they did, at the beginning of last week. But generally speaking, when we look at kind of the patterns, historically speaking, with the sheer amount of volatility we saw last week, chances are that volatility is not just completely done and over with. Chances are we typically still get some retest of the lows for both the S&P and the NASDAQ. And once we get that, I do think that we have a tradable bottom for investors to kind of start buying. So with that covers what I wanted to share with you here today. As things develop here next week with the CPI print, we'll continue to update you on how our outlook may have changed. With that, thank you so much. I hope you guys have a great trading week.